Welcome back to Wall Street Podcast. Today, we're pulling back the curtain on Broadcom, a tech giant, maybe quieter than some, but absolutely thriving right at the heart of the AI revolution. We're digging into a fresh research report from JPMorgan. The title is pretty descriptive. Broadcom Inc. MGMT meeting. AI demand remains strong, driven by inference, along with non-AI businesses' recovery and sustained VMware revenue growth. Business firing on all cylinders.
Right. That one just came out July 9th, 2025.
Okay, so our mission here in this deep dive is really to unpack the key takeaways from JP Morgan's meeting with Broadcom's top brass hawk tan, Kirsten Spears, GU. We want to get a clear picture of what's driving Broadcom now and what their outlook is. Let's jump right in. First things first, the headline, AI demand. Still exceptionally strong, but what's the new angle JP Morgan is pointing out? Is it just more growth or something different?
It's definitely different. There's a critical shift happening. For the last, say, 9 to 12 months, AI demand was really focused on training those big frontier models. But what's really interesting now in just the last 2 months is a major surge in inference demand.
Inference. So customers actually using the AI, not just building it.
Exactly. They're looking to monetize those huge investments they made, moving from training to deployment at scale.
And the kicker is, this new inference demand wasn't even factored into Broadcom's earlier 2027 SAM forecast, their serviceable addressable market estimate.
That's right. That forecast was already huge, $60 to $90 billion just for their 3 existing AI customers. This inference piece is incremental.
Wow, so the whole new layer of demand they hadn't fully planned for.
Precisely. It points to some real potential upside beyond what they, or maybe anyone, modeled. Broadcom's team is saying current inference demand already outstrips capacity.
Which suggests even their own bullish long-term projections might end up looking conservative on AI. Faster adoption than expected.
Much faster, and maybe broader too.
Okay, this AI demand explosion is clear. But how is Broadcom actually executing? How are they capitalizing? Let's talk about their custom AI XPU business. Any updates there?
Yeah, progress looks solid. Their 2nm 3.5D AI XPU product tape-out that's on track for this year.
2nm, that's bleeding edge. And 3.5D is that advanced packaging, right? Stacking components.
Correct, pushing performance boundaries. They're also set to tape out first-gen AI XPUs this year with 2 key prospect engagements. JPMorgan thinks it's ARM, Softbank, and OpenAI.
Interesting. And the long game.
They're working very closely with all 4 prospective AI XPU customers. The vision seems to be pushing towards building eventually a 1 million XPU AI cluster infrastructure.
1 million XPUs. That's just a staggering scale.
It really is.
Now, AI compute gets a lot of attention, but what does this compute surge mean for Broadcom's networking business? Is there a knock-on effect?
Absolutely. A significant one. AI workloads, they just demand higher performance network. It's inherent. There's a pretty clear spending ratio people observe, roughly 3 to 1. Compute to networking.
$3 on compute pulls in about $1 for networking.
That's the idea. It's like a built-in accelerator for their networking side. Every AI compute win drives significant, often high-margin networking revenue. And this creates big opportunities for capturing content, especially in what's called scale-up networking. There, you're looking at maybe 5 to 10 times more content, more dollar value compared to scale-out.
Okay, so networking is a crucial piece. Are there any challenges there? What about newer tech, like CPO co-packaged optics?
That's a good point. CPO is promising, but it does face some adoption hurdles right now. The main issue is a higher failure rate for the optical components, maybe 5 to 8%.
And the problem is, if an optical part fails,
You have to replace the whole CPO solution, not just swap out a small module like you might today. It adds complexity and cost. Needs careful management.
got it. Okay, AI is clearly booming, but Broadcom is huge, right? They have big traditional semiconductor segments too. What's the story there? Are they seeing recovery after some tough times?
Yes, they are. The management team described it as a gradual U-shaped recovery in the non-AI semi-business.
A U shape, so not a sharp V, but a definite turn.
Exactly. It follows several quarters of cyclical pressure, things like server storage, enterprise networking, the general data center market, broadband. But they're seeing it now in current bookings, in order inflection. The turn seems to be happening.
And that recovery, if it holds, could mean
Could potentially drive a positive EPS revision cycle next year. Analysts might start nudging their earnings estimates up.
Speaking of estimates, what are JP Morgan's current numbers?
Their adjusted EPS forecasts are $4.86 for fiscal 24, actual then $6.71 estimated for 25, and $8.38 for fiscal 26. So any extra boost from the non-AI side would be welcome.
Okay, let's switch to VMware. How's that integration going post-acquisition? And how does that, plus the AI chip dynamics, affect Broadcom's overall margins? Especially since those custom AI chips sometimes have lower gross margins.
VMware seems to be on a very strong path. The key is the VCF platform conversion that's VMware Cloud Foundation. It's their strategy to get customers onto a standardized, subscription-based cloud offering. That conversion is expected to fuel really strong growth through late 2026, maybe into 2027.
And the target revenue for VMware?
They're projecting the VMware revenue base hits about $20 billion in annualized revenues. After that, it probably normalizes to, say, mid to high single-digit growth, still very healthy.
And margins. How do they balance the lower gross margin AI chips with overall expansion?
Through operating leverage, mainly.
Yeah.
Semiconductor operating margins are expected to keep expanding. Even if custom AI XPUs have lower gross margins individually, the sheer volume and revenue growth means operating costs don't scale up nearly as fast.
So scale helps efficiency.
Tremendously. And critically, there's the offset you mentioned, AI networking. That's roughly 30% of their AI revenue. And that segment carries above corporate average gross margins. Plus, it has strong operating leverage itself and is growing just as fast as the AI XPU products.
So the high margin networking growth pulls the overall average up, offsetting the custom chip margins.
Precisely. It's a powerful combination, driving that overall semiconductor operating margin expansion.
Makes sense. Now, with all this growth potential, particularly in AI, what's Broadcom's strategy for using its cash? They have a history of big M&A. Are they still on the hunt?
Actually, the focus seems to have shifted, at least for now. It's quite telling. The plan, according to the JPMorgan report, is to reinvest heavily back into the business over the next 1 to 2 years.
Reinvest where specifically?
Squarely focus on capturing those huge AI growth opportunities. That means doubling down on their 7 key AI XPU customer engagements.
So less focus on buying companies, more on building deeper relationships with current big AI players.
Exactly. It signals they see more value right now in organic growth and deepening those critical customer ties rather than potentially diluting focus and resources with a big acquisition during this key phase.
And other capital priorities.
They'll also stick to returning 50% of free cash flow to shareholders, and they'll continue prioritizing paying down debt.
Okay, so summing up JPMorgan's view, clearly bullish. They're reiterating their overweight rating on the stock, ticker AVGO. Price target is $325, December 2025.
Yes, they see Broadcom as a leader across key tech infrastructure areas. They really highlight that position as the #2 global AI semiconductor supplier and #1 in custom chip ASICs.
Are there any major risks or counterpoints JPMorgan might be downplaying in this very positive report, or is it all smooth sailing?
Well, it's never all smooth sailing in tech, right? Risks always exist. You could have supply chain issues flare up again, competition is obviously fierce, or maybe a broader economic slowdown hits enterprise spending, even outside of AI. But JPMorgan's conviction seems pretty strong. It likely stems from Broadcom's really deep relationships, especially with the hyperscalers and their track record on execution, particularly in custom silicon. That gives them some insulation.
Let's circle back and dig just a bit deeper on that inference upside. JPMorgan says it wasn't accounted for in the prior 27 SAM forecast. How big could this unforecasted demand really be? And what does it tell us about how AI workloads are changing?
It could be very significant. This surge, driven by customers actually wanting to use and monetize AI, not just train it, shows the adoption cycle is moving faster than people thought, from training to real-world application. That demand being uncaptured in the forecast means there's a material potential upside opportunity. It strongly suggests the whole market for AI chips, for AI solutions, is just expanding way faster than models predicted.
So it fundamentally changes the potential scale.
Absolutely. It
Yeah.
changes the scale of future revenue possibilities. It's not just a small tweak. It suggests maybe even the aggressive forecasts were conservative because the nature of demand shifted faster than anticipated.
Okay, and the margin question again. Custom AI XPUs have lower gross margins, yet overall semiconductor operating margins are expanding. You mentioned operating leverage and networking. Can you break down how AI networking specifically enables this?
Right, so operating leverage is key revenues growing much faster than costs. But the networking piece is crucial for the margin mix. Even if those custom XPUs have, say, slightly lower gross margins percentage-wise, the AI networking hardware that goes alongside them, making up about 30% of their AI revenue, carries above corporate average gross margins.
Got it. So that 30% is really punching above its weight on profitability.
Exactly, and it's growing just as fast as the XPU business. So you have this large, high-margin, high-growth segment running alongside the main compute engine. It directly offsets the lower margin profile of the custom chips and lifts the whole segment's profitability. It's a really smart synergy in their portfolio.
Makes sense. Final deep question. The strategic shift. Away from M&A towards reinvestment in AI growth and existing customer relationships. What does this really signal about Broadcom's confidence in its own pipeline, its organic strategy, for the next couple of years?
It signals tremendous confidence, I think. Profound confidence in their internal capabilities and the sheer size of the opportunity right in front of them with AI. By choosing reinvestment, especially focusing intensely on those 7 key AI XPU customers, they're basically saying, our best path to growth right now is to go deeper with these partners, leveraging our existing strengths.
Rather than go broad through acquisition?
Precisely. They seem to believe they have enough runway for massive growth just by executing well on their current custom AI ASIC and networking leadership. They don't need to buy growth or new capabilities right now because the organic opportunity, particularly in AI infrastructure, is so vast, they're betting on themselves.
So to wrap up, we've really unpacked a lot here. Broadcom's fundamentals look strong. You've got surging AI demand shifting towards inference, a recovery playing out in the non-AI segments, and that sustained very profitable growth from VMware.
Yeah, it's a compelling picture. This deep dive really shows how focusing strategically on your core strengths, but also adapting quickly to how demand evolves like this inference shift can create huge value. It leaves you with a thought, though. How fast will AI adoption keep reshaping corporate priorities? Is this move we see at Broadcom away from M&A towards intense organic reinvestment in core growth areas maybe a sign of a new paradigm for tech leaders in this AI era?
Definitely something to think about. Thank you for joining us for this deep dive. Stay informed, stay curious, and we'll see you next time.